What if I told you one small AI chip company could surprise Wall Street over the next 12 months? Most investors are busy chasing NVIDIA, AMD, and Broadcom. But while everyone is looking at the giants, one smaller company is quietly trying to grab a piece of the AI and electric vehicle revolution. That company is Navitas Semiconductor, ticker symbol NVTS. But here's the real question. Could NVTS become one of the biggest comeback stocks of the year? Or is this just another hype story that could disappoint investors? Stay with me because the fifth reason might completely change the way you look at this stock. And before we begin, remember this isn't financial advice. These are simply my personal opinions based on publicly available information. If you enjoy stock analysis videos like this, hit the like button, subscribe to the channel, and let's get started. Reason number 1, AI data centers are creating huge demand. The first reason is artificial intelligence. Every AI model, every cloud server, and every modern data center needs power-efficient chips. That's exactly where Navitas wants to compete. Instead of making traditional processors, NVTS focuses on power semiconductors built using gallium nitride, also known as GaN, and silicon carbide technology. These technologies are designed to reduce power loss, improve efficiency, and generate less heat. As AI data centers continue expanding around the world, demand for efficient power solutions could increase dramatically. If Navitas wins more contracts in this growing market, revenue could accelerate much faster than many investors expect. And honestly, this is one of the biggest long-term opportunities for the company. But that's only the beginning. Reason number 2, electric vehicles could become a massive growth engine. Now let's talk about electric vehicles. Every EV needs fast charging, efficient power conversion, and better battery management. These are exactly the areas where Navitas is trying to build its business. As governments continue supporting electric vehicles and manufacturers release more EV models, the demand for advanced power semiconductors may continue growing. Even capturing a small percentage of this market could have a significant impact on NVTS's future revenue. This is why many investors aren't just looking at today's numbers. They're trying to estimate where the company could be 3 to 5 years from now. And that's where things start getting interesting. But here's the thing. The next 3 reasons are even more important, especially the last one, because that's where Wall Street could completely change its opinion on NVTS. Here's something many retail investors overlook. Technology companies don't grow alone. Partnerships matter. Whenever Navitas announces a new collaboration with major automotive companies, industrial manufacturers, or technology firms, investors pay close attention. One strong partnership can completely change Wall Street's expectations. Imagine a major global customer choosing Navitas technology for future products. That single announcement could become a powerful catalyst for the stock. This is why many investors keep watching company news even when the share price isn't moving much. Sometimes the biggest moves begin with one unexpected announcement. Here's where the story becomes even more interesting. NVTS has experienced significant volatility since going public. Many investors who bought near higher prices are still waiting for a recovery. Now this can be viewed in 2 completely different ways. Some people see weakness, others see opportunity. If the business improves and earnings continue moving in the right direction, investors could start returning to the stock. History has shown that beaten down, growth stocks can sometimes recover much faster than people expect. Of course, recovery is never guaranteed. But that's exactly why NVTS remains one of the more interesting high-risk, high-reward semiconductor stocks. Now here's the biggest reason. The stock market doesn't always reward companies for what they earned yesterday. It often rewards what investors believe they'll earn tomorrow. If Navitas starts reporting stronger revenue growth, improving margins, better guidance, or lands several large customers, market sentiment could change very quickly. We've seen this happen many times with technology companies. Once confidence returns, momentum investors often follow. And that's when price movements can become much stronger than fundamentals alone might suggest. This is why many investors are watching every quarterly earnings report very carefully. Now here's my personal opinion. I believe NVTS is an exciting growth company, but it's also a high-risk investment. The technology looks promising. The markets it's targeting, AI, EVs, renewable energy, and data centers are all expected to grow over the coming years. However, the company still needs to prove that it can consistently increase revenue, improve profitability, and execute its long-term strategy. If management delivers strong execution over the next 12 months, I think a price range of $8 to $20 looks achievable. If multiple positive catalysts arrive together, an optimistic scenario could push the stock toward odd or even $20. But if growth slows or earnings disappoint, the stock could remain volatile or even trade lower. That's why I personally consider NVTS a speculative growth stock rather than a guaranteed winner. Now I want to hear from you. Do you believe NVTS could become the next big semiconductor success story? Or do you think investors are expecting too much? Write your 12-month NVTS price prediction in the comments below. If you enjoyed this analysis, don't forget to like this video, subscribe to the channel, and turn on notifications because I regularly cover fast-growing AI and semiconductor stocks before they become mainstream. Thanks for watching, and I'll see you in the next video.